But like many things, you have an initial hype cycle when everybody goes wow, and then you have a crash typically after that, and then you have the realistic return to optimism driven by people actually doing things and evidential um, information that shows that adoption is actually happening.
Fred Thiel is the CEO of Marathon Digital Holdings, and he's here to talk to us about the recent news in the Bitcoin and crypto space. Fred, welcome back to the show. Pleasure to see you again.
Great to be back.
Marathon Digital Holdings is the largest Bitcoin miner in the United States, and we're talking about your operations and any changes to your operations and strategies later on in the interview. But first, let's talk about recent news coming out of the Bitcoin space. I want to first ask you about the filing for the spot Bitcoin ETF by BlackRock. It came to the attention of the markets this week, and it was a surprise to many. Were you surprised that this filing was finally made by the world's largest asset manager?
I think I was a little surprised by the timing, though not surprised by the event. I'd said a few years ago that this industry, the regulators would always favor the incumbents. And I think you could, on the one hand, if you're a conspiracy theorist, you could say, well, the SEC has been clearing the decks so that the incumbents could come in. On the other hand, you could also say it just takes a long time for the incumbents to get their ducks in a row and make sure everything's in alignment. BlackRock is approaching this in an interesting way. They've been accumulating Bitcoin for the past 6 to 9 months in purchases in the market. They've structured this slightly as a hybrid in that, unlike prior ETF applications from Valkyrie, ARK, and others, this is structured in a way that provides the SEC with market surveillance. And the SEC's counter argument to these ETFs has been risk of market manipulation, et cetera. It's interesting to see that BlackRock obviously chose Coinbase. They're a large investor in Coinbase, I believe. So they're obviously going to favor one of their portfolio companies. But the timing was interesting. It seemed a little bit coincidental, maybe, that while all the pressure is on these US-based exchanges who are now kind of moving offshore, all of a sudden BlackRock comes in with an institutional grade product. Of 355 ETF applications that they've made historically, I believe the number is 354 have been approved. So they obviously wouldn't do this unless they had a belief that they were going to succeed. And NASDAQ has a custody application in with NYDFS that should be decided on in July here. And there's been some noise about NASDAQ potentially as a next step looking to do some form of trading of Bitcoin and ETF, Bitcoin and Ether on their exchanges. So I think it's going to be very interesting to see how this plays out. But obviously, likely, existing incumbent institutions that are trusted by the regulators will play a bigger and bigger part in this industry. And it'll be interesting to see what's kind of left for Coinbase and the others as the regulators require them to kind of break up their businesses into separating custody and trading, et cetera.
I wonder what the source of this confidence would be if BlackRock is certain that this would pass. Otherwise, they wouldn't have either started this or be looking into this or filed this at this time. We've seen many attempts by other firms. Grayscale, just to name something off the top of my head, their application for a spot ETF was rejected on the premise that the SEC didn't think it met their anti-money laundering standards or anti-fraud protection standards. And so either the standards have evolved or the process for filing ETFs has evolved.
Or the SEC needs to, let's just say, improve the perception in the marketplace that they're not just trying to kill crypto, but that they're actually enabling. You look at this Prometheus exchange that magically made it through the SEC's process and was approved and was highlighted as a poster child at recent hearings in Congress for the SEC. Be able to prove that, yes, you can get approved if you just follow the right channels and do the right things. I think BlackRock's fund, as I said earlier, has been investing in Bitcoin. I think they believe Bitcoin is going to make a run. Wouldn't it be convenient that you have a large accumulation of Bitcoin that you can drop into an ETF instrument all of a sudden and monetize quite nicely and generate a nice gain on it. Fidelity has had their custody product, obviously, and offers trading. Charles Schwab and others have launched this EDX exchange, which is regulator friendly. They don't do custody. It's for institutions only to do trading. It's kind of like a hybrid between an OTC desk and an exchange. So I think all these people talk. BlackRock obviously has a lot of sovereign wealth investors. Sovereign wealth funds are investing heavily in this. Our partners in UAE are one of the largest sovereign wealth funds in the world. They're obviously very focused on digital assets. UAE as a country is very focused on it. Bhutan is now investing in it. There's more hash rate growing in non-public companies than in the public companies. So if you look at the global hash rate growth of all the public companies and you look at global hash rate in general, global hash rate's growing faster than the public companies are adding hash rate, which is new. And so that says that there are a lot of people who either are coming into this industry who are new to it, or there's a lot of money all of a sudden coming in that's funding people to grow their capacity.
Mm-hmm. Okay, well that leads us to the market itself. Now the Bitcoin price has breached $30,000 twice, I believe, this week. Just today, we're speaking on Friday. It's back above $30,000. The last time we saw $30,000 was actually, prior to this week, was actually last year. So it's been a long time, Fred. What are the key drivers for this push upwards? Keep in mind that I think a week and a half ago, not even 2 weeks ago, the market was despondent in light of the lawsuits against Binance and Coinbase.
Well, if you look at the step ups in Bitcoin's price this year, they've been event driven, right? The step up from 21 to 28 most recently, before it pulled back to 25, was driven by the banking crisis. Before that, we saw the expectation that interest rates would potentially drop. Driving. So I think what we're seeing is, there's not a lot of liquidity in Bitcoin. Most of Bitcoin is held off exchanges. It's held in cold storage. The vast majority of wallets haven't moved in a long time. And so it doesn't take a lot of interest to move the price of Bitcoin a whole lot right now. And I think what we're starting to see is not just in Bitcoin itself, but, look at the shares in Bitcoin exposed stock. Look at what's happened most recently in like companies like ourselves. We have 160 million plus shares outstanding, and we traded over 80 million shares a day, 2 days this past week. On strong uptick in price. So that says that there's a lot of interest all of a sudden coming into this space, and they want exposure across the sector. All the mining companies are way up. And it's not just because the price of Bitcoin is up. It's because people believe we're now going into a new bull run, I believe. But, again, I'm not going to prognosticate where this is going. I have my theories, but I think, we're going to see people believing that the trend historically will repeat itself as we go into the halving. And, by the end of next year, we'll see some strong price appreciation if it follows historical patterns.
Well, we can take history as a guide. Were there any specific news or events that you could attribute the last bull run to? I'm talking about the one in 2020, 2021.
There were a lot of things, and not dissimilar to now. It was a lot of that run was around the belief that institutional adoption was happening. And so there were a lot of ETFs were being filed. You had a lot of belief that you would have some form of positive regulatory environment, but a lot of it was just around institutional adoptions beginning to happen. And you saw a lot of, Druckenmiller was talking positively about Bitcoin. You had a lot of these traditional financial kind of titans talking about digital assets as an interesting area. And I think you're seeing a little bit of a repeat of that now. But like many things, you have an initial hype cycle when everybody goes wow, and then you have a crash typically after that, and then you have the realistic return to optimism driven by people actually doing things and evidential information that shows that adoption is actually happening. Wallet volumes and balances continue to increase in Bitcoin. That speaks to broad adoption. Lightning is slowly but surely being adopted in more and more places. You're seeing layer two applications in the Bitcoin space becoming more and more relevant. So, I think we're going to continue to see adoption. And what excites us, obviously, as a Bitcoin miner, is the fact that Bitcoin's dominance, market dominance, is now almost at 50%. It touched 50% the other day, and at the detriment of altcoins and to a lesser extent Ether.
You and I spoke about Bitcoin mining costs, but also Bitcoin transaction costs overall last time. An interesting trend this year that's pushed up the transaction costs is more development activity on the Bitcoin layer one, in particular the Bitcoin ordinals protocols. What's the most likely outcome from increased activity from developers on the layer one?
Yeah, I think you're going to see most of the development happen at layer two. Part of the problem with the ordinals is similar to with when NFTs first came out on the Ethereum blockchain, is you have limited block space, and ordinals tend to be data intensive. And so they're competing against financial transactions. And so the mempool, which is, think of it as the inbox for the Bitcoin blockchain, as that starts getting backed up, people start bidding up transaction fees to try and get their transactions prioritized. And the mempool has now added a tiered pricing structure that they're deploying so that you can set priority for your transaction in a more proactive way. But that competition for block space is what drove the transaction fees to jump up. And the way to deal with that is you essentially deploy the solution at layer two that then just settles on the Bitcoin blockchain. Now you free up the mem space and the block space rather, and you can do many more transactions, higher volume. You could create a layer two, for example, for ordinals, where you could have a 1 gigabyte sized memory space in each block, where you could put lots of graphics or even videos, even movies. And so I think there's much more flexibility at layer two, and you have the benefit that the layer two chains can settle on the Bitcoin blockchain, meaning their hashes can be stored on the Bitcoin blockchain. So you get all of the security and benefits of the Bitcoin blockchain without the cost of having to replicate the Bitcoin blockchain, without the cost of having to do proof of work or proof of stake. You're using Bitcoin's own security system as a way to ensure the validity of your blocks.
Has that development changed mining costs at all? Was there any impact whatsoever?
No, I think, obviously, as ordinal volume dropped, transaction fees have come back down, kind of back in the area where they were. They're still slightly elevated, but they're not at, greater than 1 Bitcoin per block anymore, certainly. I think what we're going to see, though, it's, again, continued Lightning adoption, more layer twos that'll come here over the next 6 months. We're certainly very focused on looking at what are the enabling technologies that we could bring to bear to help the ecosystem develop. And we think it's a very interesting space. We also think that there are potential opportunities as AI becomes a more relevant technology. You think about how the AI industry is developing. And now I'm talking about companies using these large learning models, these LLMs, to develop inference models for their businesses. They're not going to want to share their data with public LLMs so other people get the benefit of their data. They're going to want to keep their data proprietary. So you're going to start seeing an interesting confluence of AI and blockchain technologies. And again, I think with these AI tools, people are going to want to make sure that something hasn't been modified by AI. So for example, you could have a government report on frozen orange juice futures, let's say, that comes out. You would want that report to be stored in a way so you could prove that it had not been manipulated or in any way changed by some tool, just like photographs, images, movies, videos. AI today lets you manipulate things in such creative ways. People want to be able to protect their copyrights. They want to protect the authenticity of things. They're going to want to protect the provenance of things, whether it's wine trading, art trading, whatever valuable asset trading. So I think there's going to be this need to have a very secure place that you can go to validate that something really is what it is. And that is going to be the Bitcoin blockchain at layer 2 or layer 3. And you're going to see, I think, very many applications for things that have nothing to do with financial transaction settlement being built on top of the Bitcoin blockchain that act as ways to secure the validity of data so that in a world where AI can do pretty much anything, you can prove that something is real and hasn't been adulterated.
Interesting. Well, you said specifically there will be a confluence of AI and blockchain technology. What is that confluence exactly?
Well, I think you're going to see applications that either are, validators, let's say, for it could be government data, it could be corporate data, it could be personal data, it could be provenance data regarding things, where you essentially build these tools to protect against AI manipulation. By the same token, no pun intended, you could have tools that essentially act as copyrights of information that AI could use to do things with, right? Because if you think about how an inference engine works and these large learning models work, they're ingesting huge amounts of data. They are learning from that data, and that learning drives their behavior. Well, the old expression, garbage in, garbage out, says that essentially, if you give an AI the wrong data, it will build the wrong inferences. So it becomes very incumbent on producers of these tools and the output of these AI that the data they're ingesting is valid and not invalid, so that the inferences are valid and not invalid. And the only way you can prove that is by having that data available on public blockchains where anybody can go and validate it. And so I think that's where you're going to start seeing the use of blockchains.
Could AI or any computer software be advanced enough today to alter transaction records on the blockchain?
No, because that's an encryption problem, right? So quantum computers are not there yet. And the changes needed to be made to the core Bitcoin core software to make that even harder are fairly easy to implement. You're simply increase the difficulty and methodology of how the difficulty is calculated. If you were to talk to post-quantum encryption specialists, the bigger problem with quantum computing and hacking is all the bank passwords. Today, every single user access methodology is based on asymmetric keys. An asymmetric key is a system where it's very, you use seed phrases, et cetera, to generate a key, and then you can validate that key using public-private key. That's essentially how a lot of wallets work today. And so the quantum computers are especially adept at cracking asymmetric key systems. And there's a consortium of companies, including Microsoft, Google, and others, who are developing passkey technologies and other technologies that are quantum proof. The biggest target right now are banks and financial institutions. You point a quantum computer to a bank, hack all the passwords, and take 10 cents out of everybody's account. And before you know it, you have billions of dollars, and nobody's the wiser for a while, right? So with the Bitcoin blockchain, if you were to point a quantum computer and try and crack Satoshi's wallet, the minute a Bitcoin moves from that wallet, the world would know it. So they're much bigger fish to fry for quantum computers than going after crypto today. But I think by the time that is an issue, it'll have been modified to protect.
And I think people pointed out to me that if quantum computers were sufficiently advanced to break to break blockchain, it would already be breaking other passwords and financial and banks and whatnot. So there needs to be better security overall. Just on that note, is there a way to develop countermeasures from the blockchain Bitcoin community?
Yeah, I mean, the post-quantum encryption consortia, which are groups of companies like Microsoft, Google, and others, and even the federal government put out an RFP for quantum-proof encryption technologies. And those RFPs were submitted last year, the spring of last year, and they're now NIST, which is the Government Standards Setting Institute, is now determining, they're kind of focusing on two technologies, and they'll end up picking one or just recommending both. And then what you'll start seeing is companies like RSA and others start rolling out these technologies to their clients so that they can implement them. But you may have started seeing news about pass keys and more biometric type key systems, and that's part of this. It's not the solution, but these post-quantum or quantum proof encryption technologies are things that you'll start seeing rolling out over the next 2 to 3 years.
Okay, so generally, you're not concerned about hacking being an existential risk to Bitcoin right now.
No, I think there are, as you said earlier, much bigger fish to fry around that, and it's a nation state level activity today. U.S., China, potentially Russia, North Korea, maybe. It's not something that your average criminal organization is going to have access to.
Okay, well, let's turn to regulations now. Now, the SEC suit against Binance has taken a turn as Binance now turned the table and countersued them for misleading statements. So we'll see how that develops. My general question is whether or not changes in the regulatory activity have, well, I wouldn't say changes, but developments in the regulatory landscape in the U.S. have prompted you to look elsewhere for operations.
So we began a process of looking at international expansion last year, actually really at the end of 2021 initially, when we started having conversations with folks in UAE. We were searching specifically for areas where there were large energy usage asymmetries, where you had a lot of excess energy at partial times of the year, and UAE is a poster child for that, where they have in the summertime 4 gigawatts of demand, and in the wintertime only 1 gigawatt of demand for energy. And so that project is now, in its really final stages of execution. They're in the process of, we're well along in the installation process, and that'll be fully live by the end of Q3, most probably this year. We're also looking in other countries, and our goal is to be about 50% US, 50% offshore in our mining operations over the next 4 to 5 years. We think that the need for diversity is not just regulatory in nature, but the amount of available energy and people's willingness to give us stranded energy is changing. We have EVs coming on. We have mandates to electrify everything. And so we believe that the renewable energy companies, battery technology, et cetera, are going to advance more and more, such that the benefit we bring to the grid at utility scale, I'm saying large scale sites, will start decreasing over time. And what we will be focused on, for example, domestically, is much smaller scale sites where we actually focus on generating energy ourselves and controlling the whole stack. So we own the energy generation all the way through to the Bitcoin mining, where we can take truly stranded energy like landfill gas, biofuel, things like that. So we're helping the environment, we're reducing methane at the same time as we're converting that to energy, and we're not being parasitic on the grid at all. And potentially we could be a seller of electricity if pricing made that attractive. Internationally, however, we believe there are still opportunities for large utility scale sites. And so internationally, we'll continue to look for these big projects like UAE, which is 250 megawatts, like things that are going on in Latin America, Bhutan, places like that. And there are some very interesting opportunities to partner with energy infrastructure companies to develop a lot of renewable energy in these developing countries, especially.
Sorry, did you say you wanted to potentially look into selling energy back to the grid? Are you trying to diversify your operations away from solely mining Bitcoin?
Well, if you think about as you integrate vertically, we integrated from just taking miners and going to the third-party hosting sites. We're now developing our own sites. We have developed our own technology stack. Gosh, it kind of seems logical that you'd go the next step down and start developing your own energy generation. And if you're at your own energy generation, now all of a sudden there may be times where the market is pricing energy at a price where it makes sense for you to sell energy to the market as opposed to mining Bitcoin, right? That can happen. So, I'm not saying that our strategy is to go in to become an energy producer with the goal of selling energy to the market, but by converting energy to Bitcoin, we effectively are doing that, right? We're converting energy into Bitcoin so that energy can be used somewhere else.
Um, let's talk about something that I found interesting. I'm looking at your income statement for 2022 year end. Total revenues were about $117 million. Now, you have a line item called impairment of digital assets, which was a negative $173 million. So overall, your total operating expenses exceeded your total revenues for 2022. Can you comment on what that is?
Sure. So the way the accounting rules work in the United States, and let me preface this by saying that FASB, who kind of drives what accounting standards are, has already recommended that these rules change, hopefully effective in 2024. So that currently in the US, if you hold Bitcoin, it's deemed a long-lived intangible asset. It's kind of like a patent. You can't mark it up in value. You can only mark it down in value. And so if you look at the Bitcoin that we mined and the Bitcoin that we held in our balance sheet at the end of 2021, we were mining Bitcoin and the price of Bitcoin was, obviously near $60,000. We recognize revenue and the value of the Bitcoin at the time we mine it. So we had Bitcoin on our balance sheet that was valued at $61,000 a Bitcoin. As the price of Bitcoin dropped, and remember, December of last year, the end of last year, Bitcoin was in the close to $15,000. You have to mark that down. And so you look at all the Bitcoin we had in our balance sheet, and you have to market all of the Bitcoin down to the lowest value at the time. And the accounting rules are so
it's
finicky
really
about this.
It's non-cash
actually the lowest. Yeah, it's a non-cash expense. Just like we also had a large impairment charge for our equipment because as mining equipment pricing falls, you have to mark it down as well. So that's just standard accounting rules. Non-cash charges. And if you look at our Q1 results, you'll see that there was no impairment because Bitcoin price is actually moving up. And the unfortunate thing is we can't then mark it
up. Yeah. Okay.
But FASB's rule change hopefully will, if that's adopted, which we believe it will be, then it'll be marked to market. And by the way, much bigger news than BlackRock doing an ETF is the adoption by FASB of mark to market, because a lot of investors think of Michael Saylor's out there touting you should put Bitcoin on your balance sheet. Why don't companies do it? Yes, there's volatility risk, but you talk to any analyst and they'll tell you the risk-adjusted returns for Bitcoin are better than any other asset over any period other than 2 years, right? So why don't they do it? Well, because they don't have mark-to-market treatment, which means when they carry it on their balance sheet, it would only be impairable. It wouldn't be mark-to-market. The minute you have mark-to-market treatment, that opens up the door for corporations to now hold Bitcoin on the balance sheet. That is a much bigger driver of increased demand for Bitcoin than an ETF. An ETF might have a few $1 billion of value in it. Corporations putting 1% of their balance sheets into Bitcoin is trillions of dollars.
But they're not able to do that because of accounting standards, you said, currently?
Well, they're not incentivized to do it. Imagine here's a company and you're telling the market what the value of your assets are, and you have these things on your books that you can only impair. You can't mark to market.
Yeah. Okay, that makes sense. Okay. Well, investors will just have to look at the footnotes and realize that's not, it's not an operational defect. It's impairment of digital assets. But okay, right. Fred,
but psychology drives markets, right? So
yeah, fair enough. Well, your stock has done very well this year. I'm guessing that's because of the Bitcoin price.
Yeah, I mean, we are again back to this whole institutional investors. What alternatives do they have for holding spot Bitcoin? Many of them can't because of their own governance standards and rules. So what alternatives do they have? Well, equities that are exposed to Bitcoin. What are the best equities from an exposure to Bitcoin perspective? Well, Marathon is one of the ideal ones because of the publicly traded miners, we're the largest holder of Bitcoin with over 12,000 Bitcoin in our balance sheet. And so we're a perfect proxy because we give you not only exposure to Bitcoin, but exposure to the margins of mining. And, Warren Buffett has, famously been quoted in the past as saying, I don't buy gold, I buy gold miners because I want exposure to the margins. And in a period where Bitcoin price is expected to run up, our cost to produce Bitcoin is fixed from an energy perspective because, energy prices don't vary at the same rate that Bitcoin does. But more importantly, global hash rate in today's market, it's hard for miners to raise capital other than the large miners like ourselves. And so the growth in global hash rate is not expected to be as insane as it was in 2020 and 2021. And so people are thinking, well, miner margins are just going to go through the roof. And so if you have miners with high margins and they keep holding Bitcoin on their balance sheet, then you get this compound effect, which people want exposure to.
If investors were to ask you, Fred, how could you minimize your operational costs? What are some of the ways that you can respond?
Well, if you look at us compared to our peers in the industry, we most probably have one of the leanest cost structures around SG&A of any of our competitors, because we don't have hundreds of employees. We have 40 employees today as a company. So our SG&A is very low. And as we continue to deploy, our fleet, it's the most energy efficient fleet in the industry at about 24 joules per terahash. We have an opportunity to have enhanced margins. And then we're very focused on lowering energy costs and doing things to bring our energy costs lower and lower over time.
Would the fixed cost of operating in the U.S. be higher than other jurisdictions?
Well, the primary cost driver for Bitcoin mining is the energy cost. So, for example, in the U.S., you can find energy from little over 2 cents per kilowatt hour up to as high as 5-6 cents per kilowatt hour in some places. We have the benefit of sitting at places like in West Texas, where we're behind the meter at a wind farm, where we have a direct PPA for the wind energy at very low cost. So you can find low cost energy. Internationally, you can also find those opportunities. There are places in Latin America today where you can find low cost energy, where you have a glut of energy. You have places in Asia where you can start finding that too. And you have opportunities for developing new energy generation sources based on geothermal and others in Africa, where you could find energy at sub 3 cents a kilowatt hour. And that's very attractive, especially if you can find an alternative use for either the heat or other means to offset that energy cost. Then, as you get closer to a marginal cost to produce a Bitcoin of the operating overhead as opposed to the energy cost, it starts becoming a business where you can be profitable kind of no matter what the price of Bitcoin is, well into the future.
Is that where you're going next? Sub-Saharan Africa?
Let's just say that, we're evaluating a number of continents around the world.
All right. Finally, let's close off on sentiment. So given the topics we've discussed today, I think regulation is a concern for many retail investors. If someone were to say to you, Fred, I'm not feeling confident about Bitcoin overall, primarily because all these major exchanges are getting sued left and right, and I don't know that my Bitcoin will be safely custodied, let's put it that way, or even I'll have access to these Bitcoins if I invest somewhere with like an exchange like Binance. And therefore, I'm going to put off my Bitcoin investment until there's more clarity or less volatility in the regulatory landscape. What would you respond?
So I would say, well, would you trust opening an account at Fidelity or Charles Schwab to buy stock? Yes or no?
Sure. I mean, historically, let's just role play that. Historically, they haven't been sued to the ground. So I would say I'm feeling a little bit better. Yes.
Yeah. So you could go to Fidelity today and open an account and buy and sell Bitcoin, and they hold it by a trusted custodian. So I think the excuse is more one of fear of it being banned than lack of, good custody systems. And I think, again, as more of these institutional players come in, both of those sentiments will shift more towards, okay, well, maybe it is okay to go in. And then I think we'll start seeing the retail buyers come back in.
It would be interesting. Have you ever considered becoming or starting some sort of wallet or exchange service? It would be interesting to see a miner vertically integrate with point to point. Yeah.
No, I think it is a totally different business. Miners who are privately held are unregulated businesses, and they want to remain that. Those that are publicly traded are regulated only by the fact that they're a publicly traded company. And I definitely would not want to become from a financial services perspective, a regulated entity.
All right. Well, Fred, I appreciate your time today. Thank you for your update, and I'll speak to you again next time. Thank you.
Absolutely. Thank you.
And thank you for watching. Don't forget to subscribe.